Today, in this video, we will discuss the issue of shadow banking and its impact on financial sector stability in India. Shadow banking refers to financial institutions that operate outside the conventional banking but provide similar services such as loans and credit. In India, NBFCs, that is, non banking financial companies, are a major component of the shadow banking sector, contributing significantly to the financial inclusion. As of March, NBFCs accounted for approximately 12% of total credit in the financial system. While they provide credit to undeserved sectors like small businesses and rural households, their lack of strict regulation poses significant risk to financial stability. The primary concern with shadow banks is their vulnerability to liquidity crisis. Unlike traditional banks, NBFCs do not have access to public deposits and often rely on short term borrowing to fund long term loans. This creates an asset liability mismatch, leaving them exposed during financial shocks. A striking example was the IL&FS crisis in 2018, when infrastructure leasing and financial services, one of India's largest NBFCs, defaulted on its obligation. The crisis triggered a ripple effect, causing panic in financial markets and exposing weakness in the regulatory oversight. By March 2019, the liquidity crunch led to a slowdown in NBFC lending, impacting sectors like real estate and automobile sales. Additionally, shadow banks are interconnected with commercial banks and mutual funds, further increasing systematic risk. In response, the RBI has taken several steps to strengthen regulation and mitigate risk in the shadow banking sector. In 2022, the RBI introduced the SPR framework, scale based regulation, which classifies NBFCs into four categories based on their size and systematic importance. This allows for proportional regulation with stricter oversight for larger entities. Additionally, NBFCs are now required to maintain a liquidity coverage ratio to ensure they have sufficient cash reserve during stress period. The introduction of prompt corrective action framework for NBFCs is another significant measure ensuring early intervention in case of financial weakness. Furthermore, to diversify funding sources, the government has prompted the use of asset-backed securities and established liquidity support mechanism through entities like the National Housing Bank. Despite these efforts, challenges remain. Many smaller NBFCs struggle to meet the capital and liquidity requirements, leading to concerns of credit tightening. Regulatory arbitrage also persists, with some entities finding ways to bypass oversight. Additionally, the reliance on credit rating agencies for assessing NBFC health can be unreliable, as seen in the IL and FS case, where agencies fail to detect early signs of distress. Ensuring effective implementation of regulation, strengthening financial reporting standards, and enhancing data transparency are crucial to overcoming these barriers. Shadow banking plays a critical role in India's financial ecosystem by supporting sectors undeserved by traditional banks. However, unchecked growth and inadequate oversight can lead to systematic crises. Moving forward, a balanced approach that supports NBFC growth while ensuring financial stability is essential. Strengthening regulations, enhancing transparency, and maintaining close supervision will contribute to a more resilient financial sector. With these measures in place, India can ensure that its shadow banking sector continues to support economic growth without compromising financial stability. Thank you.